Have you ever opened the market, seen everything down, and immediately checked the news? Sometimes, you look for an explanation, but the headlines don't give you one. Markets don't always need bad news to fall, they just need pressure, and that pressure often builds quietly, long before anyone notices it. Most people assume markets move because opinions change or investors suddenly decide something is good or bad. Sometimes that's true, but many of the biggest market moves have nothing to do with opinions at all. Markets often move for reasons that have nothing to do with emotions. They move because of how the structure works, how money is funded, and when pressure forces action. Imagine you buy an apartment with a mortgage. As long as prices are stable and your income looks fine, the bank leaves you alone. Then, conditions change. Maybe prices fall. Maybe interest rates rise. Maybe the bank tightens its rules. And suddenly the phone rings. They're not asking what you think about the apartment. They're asking for more collateral. At that point, you don't really have a choice. You're responding to a requirement. Markets work the same way. A huge amount of selling happens not because someone changed their mind, but because they're required to reduce risk. That's why markets can fall on days with no dramatic headline. The reason isn't emotional, it's structural. This kind of selling usually starts quietly, underneath the surface. Borrowing slowly gets more expensive, markets start moving around more than they used to, and things that normally move together don't anymore. Nothing breaks immediately, but the margin for error shrinks. And when enough positions rely on the same assumptions, even a small change can trigger a big move. To make this concrete, let's talk about a real example. For a long time, Japan had extremely low and at times even negative interest rates. That made the Japanese yen very cheap to borrow. So investors around the world borrowed yen and moved that money into places like US bonds, stocks, and anything that paid more than the near-zero returns available in Japan. On the surface, it looked like a safe bet. And for a long time, it was. Borrow cheap and put the money to something that pays more and earn the difference. As long as rates stayed low and nothing moved too fast, the trade worked quietly in the background. But there's a hidden assumption in this kind of setup. It assumes conditions won't change too fast. If borrowing suddenly gets more expensive, or the exchange rate moves against you, or both in the worst case, you can start losing money even though the asset you bought hasn't changed. The trade turns negative because the conditions around it changed. And when leverage is involved, small moves matter a lot. Now zoom out. This isn't one investor making one trade. This is many large institutions running similar strategies at the same time. When the assumptions break, positions don't unwind slowly. They're cut. Assets get sold, loans get repaid, risk gets reduced. And here's the key point. That selling doesn't show up as bad news. It shows up as sudden weakness in markets that felt fine a day earlier. This type of situation isn't unique to Japan. The same thing happens with other trades that rely on cheap money. They work as long as markets stay calm. But once something changes, like borrowing getting more expensive or markets becoming less stable, the setup starts to break. And when that happens, people don't slowly rethink their positions. They cut them and risk comes off quickly. Not because they suddenly became bad investments, but because they're forced to exit under pressure. And this is also why sell-offs often feel sudden. The stress builds slowly and the release is fast. Think of it like tightening a spring. Nothing happens for a long time. Then suddenly, it snaps. That snap is what people call a no-news market drop. But the news wasn't missing. It just wasn't visible. Another piece of this puzzle is the bond market. Bonds aren't just investments, they're also collateral. They sit underneath a huge amount of the financial system. When bond yields move fast, money suddenly gets more expensive. Loans cost more and risk limits tighten. Investors are forced to make changes. That's why trouble often shows up in the bond market first. Stocks don't always react right away, but the pressure doesn't disappear. It usually slowly makes its way there too. When you look at markets like this, price moves make a lot more sense. Red days aren't always fear, and when the news go quiet, it doesn't mean nothing's happening. It could mean that the system is shifting. And shifts are rarely smooth. So the next time someone says, the market fell for no reason, what they usually mean is, the reason wasn't obvious on the surface. If this helped you see markets a little more clearly, let me know what topic you want broken down next. I share more breakdowns like this on my channel, so if you want to keep learning how these things actually work, you should subscribe so you won't miss a future video. Thanks for watching, and I'll see you next time.